Hey guys, welcome back to Chalkboard Tutorials. So, in this episode, we'll be looking at financial statement analysis, what to expect or what to look for when you look at the income statement, the balance sheet, or the cash flow statement. Now, for the particulars of this video, we'd be focusing on the balance sheet, and specifically the assets and the current assets portion. So, first things first, when you look at a balance sheet, I want you guys to remember one very simple equation, and that's assets minus your liabilities is equal to your worth or equity. Now, this equation is pretty simple, but it is the bedrock of balance sheet. So anything you have in assets, once you take out your liabilities from that, it should give you the value or the equity of the business you are trying to sort of evaluate, so to speak. Now, you can sort of play around with this equation a bit. So if you want, you can let me just change the color. Right. So you can sort of find out what your assets are by taking your liabilities and adding your equity portion or your shareholder equity portion, and this should give you your assets. Now, the best way to sort of think about this equation or this formula is that it kind of functions like a seesaw. So it should maintain equilibrium. One side cannot go up with the other not coming back up to bring it to equal. So if assets go up by, say, +1, your liabilities and equity should be up by 1 as well. So simple thing is just imagine a seesaw, and if one portion of it comes up, there should be a balance on the other side as well. Right. Now, going back to the core components, let's just get rid of this. Right. So, going back to your assets, the assets are primarily divided into two sections. So the first section you'd get is current assets, which is anything that should bring you revenue in for 12 months. And then you get your non-current assets, which is anything beyond 12 months. Now, anytime you look at the balance statement, 99% of the time, the format is usually the same. So you'd initially have cash, which would be, the liquid amount you find in banks. You'd have your assets are usually made up of your machines, your lands, your PPE, so on and so forth. So if you look at a breakdown of how a balance sheet works, you initially start off with the cash or cash and cash equivalents. Now, this is basically money in the bank, liquid money that is or can be used to pay out expenses or pay out dividends. Pretty much every single balance sheet starts with cash and cash equivalents. Now, another thing to note is when you look at your current assets, all the assets are listed in terms of liquidity. So number one would be the most liquid, which is cash. Like I said, it's cash in a bank and it can be used very quickly. And going down, the further you go down, the less liquid the assets would be. So you've got your bank and it's your liquid cash. Right. Now, the second portion of your assets tends to be accounts receivable. Now, the simplest way to think about accounts receivable is, say you're a business and you've made up a product and you've had it delivered to a customer. So if you're like a clothing retailer who operates online, you've received an order and you've actually shipped out the merchandise to your customer. Now what that gives you is, it gives you something called a right of pay, a right of bill. That is money you're expecting to come back in, right? Again, it's not as liquid as cash, but it's still revenue coming in. So it comes in a very close second. Again, easiest way to remember is accounts receivables are pretty much just products that have been shipped or have been delivered, which is off the factory floor or off the shop floor, and you're just waiting on payment for it. Right. So moving on to our third asset, we have inventory. Now, again, going back to the example of a clothing retailer with a digital presence, your inventory is just products you have in your store or you're in your warehouse. So it would be clothes, it would be your jeans, your bags, your belts, stuff that's your raw materials. It's either a product that's been finished and it's yet to be sold out, or you'd be looking at the basics of it. So if it's say you own a Pizza Hut or a pizza shop, basically it would be things like your raw materials, like your dough, your flour, your vegetables, your toppings, stuff that's not yet shipped out, or stuff that's partially a product. Again, these are things that would generate revenue once you've made a product out of it and once you've shipped it out, at which point it moves from inventory up to accounts receivable. And once you get the money, it moves up to cash, which is money in your account. So the best way to think of inventory is just either finished goods or unfinished goods or raw materials. Now, the fourth section of your assets is your prepaid expenses. The best way to think about this is, say, as a clothing retailer, you've got a certain amount of insurance, which you've paid for the next 12 months. So it's January and you've paid insurance all the way up to December. Now, these aren't expenses that are going to go out for the following months. This is something you've already paid out and you're waiting in the deliverables, or you're waiting on the benefits of that insurance coverage. So it's expenses that have already been paid up front and you are just accruing the benefits. Good example would be prepaid insurance. Now, these four pretty much cover the bulk of current assets. You will find every now and then a balance sheet that contains a little more than them, but this is kind of the fundamentals of the current assets portion of the balance sheet. And in order to find the current assets, all you do is you add up number 1, number 2, number 3, number 4. So you just basically add your cash, your accounts receivable, your inventory, and your prepaid expenses, and that should give you your current assets, things that are that are to be giving you some kind of revenue or some kind of benefit. You don't have money going out for the next 12 months.